Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook. Thank you for tuning in today. My name is Charlie Hardage, and I'm the host of the Passive Investors Playbook. Today, I have a very special guest, Maxwell Nee. Maxwell is the managing partner of OENO Fund, a wine and whiskey fund. Maxwell left his corporate job, faced bankruptcy, and slept on friends' couches before opening up the world's first wine and whiskey fund. He has been featured in Forbes, the Australian Business Review, Wealth Insider, and many other media publications. Their fund is focused on capital preservation, non-correlated returns, and beating inflation. I'm extremely grateful and excited to be speaking with you today, Maxwell. Thank you so much for being here. Do you mind sharing with the guest a little bit more about yourself?
Yeah, awesome. Thank you so much. So I'm from Australia, and I share this with people. If anyone's read the book, most people listening to this would have read the book Rich Dad, Poor Dad.
Yep.
My grandfather on both sides was Rich Dad. Like, they both worked really hard and owned a bunch of real estate in like the 60s in Southeast Asia. And then my uncles and aunties and parents lost it all. So it all got,
Oh, wow.
The wealth was not preserved from them to me. So then my brother and I had to start again and, really leverage taking risks and being really smart. And we both studied finance, things like that. And when we've got a good handle on a good amount of assets right now in Australia. At the same time, I wouldn't have it any other way because I wouldn't have learned everything I need to learn up till this point.
Yeah, man, that's amazing. So your parents maybe grew up with a little bit of money, lost it, and so you and your brother had to figure out how to kind of build that back up, huh?
Yeah, I had to start again, but what it was good, because we always knew that our grandfathers were really good and savvy with money. I guess from a young age, there was always that like knowing that it's possible, and
Yeah.
just got to do the right things and do the work and take whatever risks you need to take if necessary and obviously mitigate it as much as possible.
That's awesome. So I kind of want to talk, let's start out with the real estate piece, because I know you're in a ton of real estate, and then I love this wine and whiskey fund. And so I want to do a super deep dive into that, but let's start off with the real estate because most of the audience is somewhat familiar with real estate. Do you mind maybe kind of talking about how you got into real estate in the first place?
Yeah, really good question. So I worked for Australia's biggest bank as like a corporate analyst. So basically, I would lend money to real estate developers, like yourself and many people listening. So I saw like every deal, every developer, everyone's balance sheets, everyone's strategy, like everyone's feasibilities for the whole city that I was in, because the city I was in is not super big. It's about just under 3 million people, so not like in New York City or anything
Sure.
like that. It's pretty easy for me to get a handle on everything that's going on. And yeah, just like learned a lot. Always loved real estate, love the aspect of, buying an asset, adding value to it, whether it's bedrooms, whether it's increasing rents, whether it's, improving the development application so that you can, build a car park or whatever, or raise it higher or whatever. Right. And, my brother jumped into development first. So he's a fair bit older than me. And then I went over to, I moved overseas actually and started an online education company that did really well. And it was an online coaching company. And I've since exited that now. So I was sitting on a bit of equity, a bit of cash, and then I went back and thought, okay, what do I want to do now? Where should I put this money? Because what I know is, yeah, if you don't put your money to work, then you'll be working forever.
Right.
So I love having nothing in my bank account, basically. Like I'm one of those guys. I put everything to work always. And so I did what most people would do. I gave some to my mom, put some into buying an apartment that I'm really long on apartments in Brisbane, where I'm from, Brisbane, Australia. The Olympics will be there in about 8.5 years. It's, there's a 26-hectare lifestyle casino precinct. It'll be one of the biggest casinos in the Southern Hemisphere being built
Wow.
there. And there's about, $60 billion in infrastructure, from the airport to bridges to the stadium. It's one of the only Olympics where the ceremony, the games, everything is in a city. So like the city will just be lit up on fire.
Very
Like
cool.
for example, when the Olympics was in places like China or Sydney, it was like an hour out from the downtown, right? So we're very long and bullish on Brisbane because I really believe none of that's been priced in yet, which is great. And for example, like the workforce, Australia has like the world's most middle class workforce. So it's not easy to be rich in Australia, but it's also not easy to be poor. So everyone's sort of really balanced. So like if you just own the asset, charge people rent, you could do that forever, right? Because everyone's just pretty stable. It's a very sort of stable economy. And and when you look really deep into the economy, you can see pockets of opportunity, right? That's what I love seeing, pockets of opportunity. So what's happening right now in Australia, like a macroeconomic standpoint, is there's an aging population, like a massive aging population, probably all around the world. Baby boomers are moving out of the workforce, and they were like the engine, the really big cranking engine for like the last 35 years, right? But they're retiring. Their children, the millennials, are moving out. So they're moving out of these big 5-bedroom houses, and they're sort of thinking, well, we don't need 4 extra bedrooms now. It's just me and you and the dog. What do we do? So there's a huge sort of shift happening in Oz. I think it's also happening in the UK as well, where people are downsizing. So it's like there's like a whole downsizing market. And when you downsize, you want to live in like a better location. So people either go into the beach, or they go into somewhere in a city, because they don't need to drive the kids to school anymore, right? So you don't need like to be living near the school. You can live near what you want to do, whether it's go on a boat on the weekend, go to the beach on the weekend, whether it's be in a city and sort of be where the energy and the action is, and the nice restaurants and things like that. So there's a huge demand for like luxury apartments in a city. These luxury apartments are like houses in the sky. They're like 400-500 square meters. I think that's like I think it works out to be like 4,000 square feet.
Oh, wow.
Minimum, right? 4 bedrooms, 3 bathrooms, 3 cars, in the sky. Beautiful car park in like a beautiful neighborhood that's really safe, and just full luxury. Like herringbone floors, and that all that sort of stuff's really hot right now. So the project that my brother and I are working on is basically capitalizing on all of that. It's a 36 luxury apartment project in Brisbane. It's in the highest median suburb for the state. So it's like the top dog suburb price wise, highest median price suburb. And we have 333s there, 3 bed, 3 bath, 3 cars. The 3 cars are all next to each other, and they've got a roller door. So you could have like your own little shed. You can put two cars there and a jet ski, or 2 cars there and a work desk, and have your sort of little man cave in the apartment facility. And the 333s, because Australia has beautiful weather, all have jacuzzis on the balcony.
Oh my gosh.
So it's just like this lifestyle upgrade, right? So like these downsizers that have made a bit of money, and kids have moved out, so expenses have like been chopped by like 80%. They want to live like a beautiful, sexy 7-star hotel lifestyle, and that's what really smart developers are catering for, I
Wow.
believe.
Man, that's amazing. And you said that in the UK, Australia, people are downsizing. Same thing here in the States. The empty nesters, right? Their kids
Yes.
they're all adults. They
Yeah.
go away and maybe they realize, hey, I don't have to live in the suburb. Maybe I can live closer to where the action is or where they want. So I know, and baby boomers are big generation. I don't remember the stat, but there's so many retiring every single day. And so I do think, there's a huge opportunity in what you're doing, obviously. And that doesn't even include the Olympics, which is going to be there in 8 years or so. That's extremely fascinating. So you and your brother still own that apartment complex, correct?
Yeah. So we're developing it now.
Okay.
Now. Yeah. It's on the way.
That's amazing. So I want to pivot. And well, one thing that you said that really I love, I've heard it many times before, and I love it, is you're going to be working forever if your money isn't working for you. And that was when you sold your online coaching company. You had some cash, gave some to your mom, and kind of reinvested that. And so your bank account was pretty low, but your money's working for you. And so I love that, because I think I grew up with a middle-class mindset of pinch your pennies, right? And put everything you can into IRAs and 401ks, which, you may not be familiar with that term, but it's just a retirement account in the United States. And you can't touch that until you're, like 69 or 70, something like that. If you withdraw money before that, there's potentially a penalty and taxed on top of that. So I love that, because you're having your money work for you and get that velocity of money and investing coming in. So that's fabulous. Okay, so let's pivot. I know in the intro, we kind of talked about, I mentioned that you were facing bankruptcy and you kind of slept on some couches. Do you mind maybe going into that a little bit? Just, high level overview, how you got into that position and what got you out of it?
Yeah. So that was when I was really young, I think
Okay.
I was 21 at the time. And then what happened was I bought an apartment off the plan. So off the plan in Australia means that you pay for like a sales contract that hasn't been built yet. It's like pre-construction. I think that's what you call it.
Yep.
Yeah. And by the time it was constructed, developer took some shortcuts because they, some things didn't happen the way they wanted to happen during construction. I'm sure materials changed because it was like 3.5, 4 years. The apartment was basically valued like 12% under what I agreed to pay for it. So, it came in under, which is the highest risk when you go pre-construction. And I looked at it and I thought, wow, I really, really don't want to settle this.
Yeah.
I really, really don't want to settle it. And then they were, just saying, you have to settle it. Otherwise, we can put you in the bankruptcy and all that sort of stuff. And, in like the very, very last minute, 2 weeks after the last minute actually was overdue, I found another buyer to take it off me. I just gave them my deposit. So I paid like a 10% deposit. It was 12% under. So they paid, they made a loss of 2%, more or less, right? Which isn't a lot. And then I just gave it to them because I thought, you know what, if I own this, if it's 12% under and I buy it at this price, I'm going to need to wait 8-9 years to get back to ground zero.
Yeah.
And I'm going to need to pay a mortgage for something that isn't worth what it's meant to be worth until then. So it's a dead asset. I wrote it off as a dead asset.
Okay.
So then I basically forfeited my deposit, gave it to that guy and moved overseas at the same time.
Okay. Gotcha.
Yeah.
So can we talk about the Wine and Whiskey Fund? How did you get into that? I mean, that's not something I feel like most people have heard of or know anything about. So how'd you get into the wine and whiskey investing?
Yeah. Really good question. So, when I exited my last business and I was sitting on some capital, I gave some to my mom, put some into property, and then I put some into like tech startup. I thought, you used to read those stories about huge tech startup valuations and things like that. So why not? And then I wanted to find an alternative for the rest. I wanted to be in an asset class that's non-correlated to the market, ideally something that I enjoy. Like I don't want to just invest. I also wanted to do stuff I'm passionate about. And then, whiskey had always been in my mind, wine not so much, because I went to a bar in Chicago. I went to a bar in Chicago and the bartender asked me what I wanted. It's like a really nice swanky bar, right? The bartender asked me what I want to drink. I said an old fashioned, and he said Scotch or bourbon, Scotch whiskey or whiskey bourbon. I said, of course, Scotch, And then he said, would you like to drink Macallan 12 and Macallan 18? Now, for those of you listening who don't know, Macallan's a bit like the Ferrari of whiskey. It's like really top end. Everyone knows it, And I said, I've never tried an 18. 18 means that it's 18 years old compared to 12 years old. And then I drink it. I thought, wow, this thing's delicious. Like, I can't believe I've been missing out. I want to drink this all the time, right? And then I gave some to my friend who's there with me, who hates whiskey. I said, try this. And he said, wow. And he just keeps drinking it. He drinks like half of it, right? And then I'm drinking. And then I said to the bartender, how much was this drink again? And then he said to me, 125. And then I said,
wow,
no, not the tab. How much is this drink? And he said, 125. And I thought, oh shit, well, I'm committed now. 125 US dollars plus tip, it's like 200 Australian dollars, for one drink. So I was younger then. So it was a lot of money. It still is a lot of money. And I said, but how much was the 12? And he said 25. And then like a light bulb went off. I thought, holy shit, right? So what I know about these two drinks, it's the same liquid from the same manufacturer. The only difference is the 18 was sitting in a barrel in a warehouse, in like a dark, humid, dusty warehouse for 6 years longer. That's it. No one did anything to it. It just sat there. And the top end of that return is 500% in 6 years.
Yeah.
So show me another asset class, whether it's wine, whiskey, arts, classic cars, crypto, real estate, New York real estate, San Francisco real estate, bonds, shares. Show me any other asset class I can do 500% return in 6 years and still have intrinsic value along the way, because, the 15-year-old in between the 12 and the 18 is somewhere in the middle, so you got like these little step by step, increases in value. So then I jumped straight into whiskey investing because I thought that makes a lot of sense. You can't cheat time. There's only so much of this stuff, and it will never, ever be an oversupply because it takes 10, 15, 20 years to make and 10 seconds to open and drink it. Yeah. You know what I mean? So, yeah. And not just that, people don't store it properly, or they drop it, or it breaks, or the label falls off, and then that is basically unresellable, right? So you're counting on these things to drop, around the world, right? And then you're holding like the last few from that vintage, and then there's an increase in value because of the scarcity as well.
Man, that's fascinating. And I when I was little, I used to collect baseball cards, and sometimes there's a Honus Wagner baseball card, or Honus Wagner baseball card that has sold for millions of dollars. I don't remember how many they made. It wasn't a lot, but yeah. It's like over 100 years old. And to your point, Maxwell, some of those get lost. Sometimes when they're moving, they get damaged, and so the value of those cards is diminished when it gets damaged or you lose it. And so there's at least one remaining that is sold for millions and millions of dollars every few years, and the price just goes up and up and up. And so,
with that type of thing, it's the same one just being resold because it's the only one in that perfect condition, and that's what I love about these assets as well. If you buy 100 properties, they're going to go up in value because of inflation and things like that 10 years from now, but they're also going to go down in value because they're going to depreciate, so the older it gets, the more valuable it gets compared to a house or car or whatever else.
Yeah, man, that's awesome. So you went to a bar, you spent 200 Australian dollars on this phenomenal drink that your buddy didn't even like whiskey, and he loved it. Did he end up paying half of that since he drank half of it?
No, I wouldn't do that to him. You know, it was my choice, my stupid decision, right? So yeah. And
Gotcha.
then yeah, so I did that, and then I found wine investing, and then I found this company that I now work with, bringing the wine whiskey investment to the world, and actually I'll be in Vegas next month to talk about this, in front of like family offices and institutional investors and things like that, because it's a really sexy asset class for a few reasons, like, so let me share, right? It's totally non-correlated to the market. So I could show you a graph, I could show you numbers where, you see a flat line and then you see the stock market doing its crazy thing, right? So it sits in its own lane. Why does it sit in its own lane? Because the ones that we invest in are luxury goods. They're in only the top 1%. So the market's about, $450 billion. So we only invest in the top $4 to $5 billion. Any more than that, we just would stop, and who's the richest person in the world right now? Bernard Arnault, the godfather of luxury, the CEO of LVMH. He owns 50% of that company. It wasn't worth a lot until he went in there and started amalgamating the luxury economy, what I call the luxury economy, because the luxury economy is in its own bubble. It's got its own clientele that aren't in a normal economy. It does well in a high inflation environment. If you think about inflation, right, 7%, 12%, 15%, luxury goods increase by 4 times that if they
Wow.
want to,
Yeah.
because their buyers will pay for it. And usually when inflation's high, the business owners and the top 1% of the income earners are making more money. You know what I mean? So it's catering to the people that have unlimited capital, basically. So, this is how I think about inflation, right? Because if you sprinkle inflation on top of these assets, they're going to increase by at least inflation or more, each year, as an example. Think of inflation as like a wave. It's like a tsunami, about to hit a beach, about to hit, like, I don't know, Miami Beach. And you could be on either one of two sides of that wave. You could be on the wave, on the beach side, where you're going to get wiped out by the wave, or you could be surfing the wave. So these luxury assets surf the wave of inflation, just like handbags, cars, Aston Martins, Ferraris, Lamborghinis, and all that sort of stuff, which I really love, because there's a lot of, the people that invest in these assets, they don't need to worry about interest rates. They don't worry about interest rates. They don't worry about changes in tax or whatever, because it doesn't affect this economy.
Right.
It's really, really nice in that sense. And so let me share a bit about the strategy, right? So, what we're not doing is we're not just buying bottles and barrels and hoping that the price goes up. That is speculating. What we're doing is, for example, is we're buying imagine a wine bottle, right? It's taken 10 years to get to that point, 10 years on this earth, so you only see these go through their whole cycle maybe 10 times, and then, you'll die. So 10 years, right? Let's say it's taken 10 years to get to its peak value of $100, 10 years of aging, creation, or whatever. What we don't do is we don't buy it in year 10 and hope that it goes up for another 5 more years. We look at what's doing well now at its peak value, and then we buy it, 3, 4, 5 vintages younger, but the same liquid, the same bottle, same brand. Often these brands have like 1,000 years of branding. Like, French wine has like more than 1,000 years of branding, 1,000 years of drinkers, 1,000 years of a target audience, right? We buy it 3, 4, 5 years younger at ideally, say, 30 cents on a dollar.
Okay.
And we just ride that maturation, that appreciation wave until it gets to its year 10. Then we sell it back into the market at a premium because, supply is scarce.
Wow. That's amazing. And you mentioned something about family offices. For the audience that may not know what that is, do you mind maybe giving us an overview of what a family office is?
Yeah. So a family office is basically a family business, or, just like a family that has gone into business and they've done really, really well, and to the point where they might have had like a liquidity event, whether they sell the business or someone buys half the business, or they just sort of retire and totally automate it. and they're usually worth at least about $50 million in net worth.
Okay.
Not always liquid assets, but houses and all that sort of stuff. So in the US, they'd be definitely qualified purchases, and because they're worth so much money, 50, 100, all up to 500 million, anything more than 500 millions, then sort of categorized as institutional.
Yep.
They create what's known as a family office, which is basically like their own in-house wealth management company that manages the wealth, because there's so much to manage. So they'll hire like a CIO, chief investment officer, who's usually like an ex-banker or something, and then they might put in some of their astute investment colleagues or families from other industries or other bankers into like a committee. So before they look to allocate any capital, they'll get sign off from like 3 out of 5 members of the committee or whatever. And then it becomes like its own little wealth management business, for that specific family's money.
Wow. That's amazing. So just to recap that would be a family that maybe has sold a business, came into some money, or just had money, want to retire, but they want to preserve that capital. They don't want to lose that capital.
Yeah.
And so what they do is they kind of start a new business, an in-house business where there's certain people that come in and manage that wealth. And so they'll come in and invest in real estate. They'll invest in wine and whiskey. They'll invest in some other businesses that are probably, not as big of an upside, but much less risk. Is that?
Not just that. For example, if you imagine, like a family has like even $30 million. $30 million is not a small amount of net assets, right? Even a family worth $50 million or whatever, is all in real estate. That's as everyone knows, that's one of the oldest and most traditional sort of easily understood and ways to build wealth, because everyone needs to live somewhere or go somewhere and use some sort of building. The family that has made 100% of their money in real estate is at high risk, to interest rates, changes in taxes, the economy, and that sort of thing. That's when they would start to look at alternative assets, which are usually non or less correlated to the market. So there was a report, I think it was by KKR, it said that high net worth individuals are investing on average up to 54% of their assets into alternative assets,
Wow.
Alternative investments, because they want half of it in the traditional economy, and then they want half of it in the non-correlated economy. And that's where I come in with like wine, whiskey, or they might invest in a bit more high risk things like venture capital or private equity and things like that.
Definitely makes sense. Okay. And so let's talk about your fund. I know you've been investing in wine and whiskey. Was it about 8 or 9 years?
Yeah. So the company has been executing the strategy for about 9 years now.
Okay.
Which is basically buy wine, whiskey, young. So buy it before it's reached its peak, about 3, 4, 5 years before it reaches peak, take it off the market, and then wait until everyone's drinking it, opening it, until the market thinks there's no more, then sell it back into the market at a premium. So it's a bit like buying all the land, all the waterfront land, wherever you're from, in Miami or LA or New York or whatever, waiting until everyone wants to build a waterfront house, then selling it back into the market at a premium.
Wow.
It's the exact same thing, but just with wine and whiskey.
That's great.
Yeah. And so, in terms of returns, over the last 4 years, we've done 11%, just over 11%, just over 12%, just over 15%, and then just over 15%. That's with much smaller parcel size. In terms of across about 3,000 clients, we're a pretty sizable company. We've got about more than 100 full-time staff in 4 continents, speaking 6 languages, because these are international assets. That it's not all in the English-speaking world. And but in terms of for the fund, we're targeting much higher than that, because we've got things like amalgamated buying power. You can imagine if you have tens of millions of dollars, you could, control a lot of the supply, and be able to sort of set your own price, because you're influencing so much of the supply out there.
So what you have been doing over the last 9 years is on maybe a smaller scale than what you want to do, obviously. And so you started the fund, and you're looking at getting more capital so you can buy a bigger share. So at that point, you have a lot more. You're a lot more in the driver's seat. Is that correct?
Yeah. Well, we're always in the driver's seat, but we can, we're controlling 10 cars at the same time.
Okay.
Instead of just driving one car. So if I relate it back to real estate, it's like, instead of us just going out there and developing one block on the boulevard, we develop all the blocks on the boulevard together. And because we've done that, we've got buying power. We can create value, synergistic value between them, just like with this. Yeah.
Wow, that's amazing. This is new to me. I've never heard of a wine and whiskey fund before, but you're the first fund, is that correct?
Yeah, so there's been wine funds out there, there's been whiskey funds out there.
Okay.
But as far as I know, we're the first wine and whiskey fund. The fund will be split 70% wine, 30% whiskey. And targeting returns much higher than I mentioned. Yeah.
Wow. That's amazing. That's very, very cool. I'm really, when we spoke yesterday, Maxwell, my jaw was kind of open. I was just like, wow, this is so fascinating to me. I love this. And what you're doing in apartments, I know you mentioned is more luxury. What you're doing with the wine and whiskey is more luxury. So you definitely have that, probably a different target audience, target customer than who I have. We typically look at working class apartments. In the United States, we would call it blue collar. And you have a different target audience. And I think what I've learned, one of the many things I've learned with just talking to you today, is that the luxury goods, it's not correlated to the market. So if the market's up and down, the luxury goods aren't. They're going up because they're always at a premium, and so they can charge whatever they want, pretty much, because those individuals, they have the money, and it's not about the money for them, it's about the lifestyle. It's kind of about what they want.
Yeah, like all the money's in the top end of the market. Like, for example, someone shared with me this fact the other day, which is quite interesting. Quantitative easing, like the US printed, I don't know, something like $20 trillion, in the last however many years. That's not in my bank account.
Yeah, right.
It's on most people that I know's bank account, but it is in someone's,
Right.
So and whose is it? It's in the top end of the market, the top 1% of income earners. And so if you can be on the sell side to the things that those people want, then in many ways, it can make life easier. As an example, I'll give this example. You could, and it's the same skill set. Often it's the same amount of work, right? Managing money for $100,000, managing money for $100 million. It's the same amount of work. Building a house, that's 1,000 square meters. That's really simple. Building a house that's 1,000 square meters, that's really luxury. There's just the same amount of work, just to do it to a different market. So the example that I give, that it's a bit like, if you're a mechanic, you could change a tire for a Toyota, but you could change a tire and the same amount of work for a Bentley. You're going to get paid differently, right? But because you're adding different value to a different person.
That I love that analogy. And something you said really had me thinking about all that money that's been printed over the last few years, that's in someone's bank account, not mine, not yours. I know Elon Musk, his net worth in the last 3 years has gone up 5x. Actually, maybe even more than that. It was in the 20 billions a few years ago, and it's like 180 now.
Yeah.
And probably the same thing with Jeff Bezos and, the top 10 wealthiest people in the world. It's probably a lot of that's in their bank account. So
Yeah, and we're in a contracting economy, So in a contracting economy, the top 1% do even better.
Yeah.
Like for example, the richest person in the world right now is Bernard Arnault, the CEO of LVMH, whose champagnes will be in this fund. So you'll be investing in the hard assets that he creates by investing in wine and whiskey.
Yeah. He's French, I believe. Is that correct?
Yeah. So he's the first French person to, LVMH is the first French company to achieve a valuation of over 500 billion.
Okay.
First, no, non-American person, apart from, that's just of what's documented. And then he's the first person, not American as well, to be, documented wealth over 200 billion.
Must be nice. So I want to maybe talk about how do you think your experience and expertise in real estate maybe has correlated to wine and whiskey? Like what did you take from your background in real estate that has really aided you well with wine and whiskey?
Yeah, really good question. So there's a few things. The first thing is that the fundamentals are the same. Like for example, in real estate, if you want the price of your house to double, either the free land in the area, or like either the demand needs to double or the free land to build a new house needs to halve, and wine whiskey is the same. So if you want your wine or whiskey to double in value, very loosely speaking, very broadly speaking, you either the demand needs to double or supply needs to halve. And what I love about these assets is that they're designed to be consumed. So supply is designed to be halved and halved and halved again over time. Another thing is that, in real estate, if you just find a way to just put the money in to buy the best location anywhere in the world, everything becomes easier. Getting banking finance becomes easier, attracting capital, getting investors becomes easier, getting builders in, or painters, whatever, because everyone knows, okay, this is a winner because it's in a winning location. So that's another thing. It's don't speculate too much. Just buy as blue chip as you can afford. Even if you can't get it at a really great price, you got to pay fair value, but you still got the blue chips, and there's only so many out there. You know what I mean?
Yeah.
So you've got control over something that no other people can get, no matter how much money they have, right? Unless you're willing to sell to them. So just really simple principles like that.
I love that. So the fundamentals are very, very much the same between real estate and wine and whiskey, and then buying in the best location just makes everything easier. Similar to buying the best wine and whiskey makes everything easier because everyone wants it, everyone consumes it. You'll pay, $125 for something that's been there for 18 years.
Yeah.
That's great. What would you say to someone maybe that's currently in real estate, that knows the real estate market well? How would you kind of talk them into wine and whiskey if they've never heard of that?
Yeah. So, the first thing is that I wouldn't talk anyone into anything. I'd just share, a bit of education on where these assets are best placed. So think of it as like this, you're looking, like we did 15% over the last 2 years. Call 15% as like your targeted return, if not higher, right? So think of it as a totally non-correlated double-digit return asset class that is very slow and boring. It's almost, I wouldn't say it's impossible, but if you have a broad portfolio, yeah, it's very, very not likely for it to double overnight, but that means it also won't half overnight,
Right.
You know what I mean? So
Yeah.
crypto can double overnight, right? But it can also half overnight. So this is the opposite of that. It's slow and steady wins the race, but still in the double-digit returns, like mid-teens, right? So I call it like your boring term deposit money. Like just like your boring term deposit. You sort of know more or less what it's going to be in 5 years' time, and you can get it out in the meantime, right? If you really need it. You just got to be aware it's a bit like real estate. It takes a while to sell. You're not going to press a button and sell it. You got to sort of put it on the market and all that sort of stuff, and work with someone to put it on the market. Like almost identical.
Very cool. When you guys, when your company buys this, the product, do you have your own warehouse to store this, or do you just pay someone to house it for you?
Yeah, great question. So we store most of our stock, if not with the producer, in a government regulated facility called London City Bond. So it's government regulated storage facility because these assets haven't had sales and alcohol tax added to them yet. So they're traded as commodities. They're not consumables just yet. And when it's in that facility, it's very easy to have it independently valued and insured. So just like real estate, you buy houses, you don't want it to be uninsured because anything can happen. We do the same. So from breakages, spillages and all that sort of stuff. So you've got like a real hard physical asset that has tangible value in it being independently valued and also insured.
Wow, that's awesome. So you get insurance on this just in case something happens, then the insurance company will pay for it.
Yeah.
Wow, that's very cool. Man, Maxwell, I've learned so much today. Thank you. This is awesome. What would you say are the company goals over the next 9 to 12 months?
Company goals. So it's definitely the focus right now is, inviting everyone who wants to be a part of it to be a part of the fund. If the fund is not for you, then, we can also help you to build your own private portfolio, which is where they wouldn't be in the fund. You would own them yourself, but we would just manage it for you. We could, ship it to you if you wanted to hold it at home, all that sort of stuff. But yeah, it's just out there educating the world on, the opportunity with this asset class, and it's been received really well. Like it opens a lot of doors. I was in the house of a billionaire about 5-6 weeks ago, and it was just firing me. Well, first of all, he invited me to his house, which I didn't know. I also didn't know he was a billionaire. He's in the top 100 Forbes families in America.
Wow.
And he's just firing questions at me, loads and loads of questions. And because, there's a lot of intrigue with these assets. And it just so happens the numbers are really great, and for example, and the track record of performance goes back 100 years. These assets are older than Apple and Google and all that sort of stuff. People have been drinking them for 1,000, 2,000 years. There's an index that actually tracks fine wine as long as it goes back. And fine wine, not so much whiskey. Whiskey's fairly new to the investment game. Fine wine since 1952 has beaten the S&P 500 by 420%.
Wow.
Right. So, it's not just it's cool and it's fun to talk about and all that sort of stuff. It's like these assets have been valued and appreciated for hundreds of years, and they've performed well for, what we know of the last 80 years.
Wow. You mentioned educate. Can you, when I said, how could you talk someone into it? And your answer is not really talking someone into it. It's just kind of educating them on what you do and maybe the space, because, probably not a lot of people know about this. So, do you have any other educational material? I know you're writing a book. Is the book, does that have anything to do with wine and whiskey, or what's the book about?
Yeah. So I'm writing a book called the Wine Investor's Playbook: How to Find Undervalued and Overlooked Hidden Gems in the wine market. I'll write a separate one for whiskey later, but basically, yeah, I'm writing that book. It's almost done. Yeah, I'm going to release it. It's like a really short, probably like a 17-page ebook for now, just to get something out there, and then I'll do a longer, more deep dive version later. But just to sort of give people like a taste of what's possible, really high level. Because yeah, I really believe, for example, the education in the world, like if you ask the average person, what do you know about property investing? On a scale of 1 to 10, they probably know like 6 to 7, the average person. If you ask the average person in the world, what do they know about wine or whiskey investing? It's 0.
Yeah.
So if I could just push that up closer to 6 or 7 to the average person, then everyone would, put a bit of their money in property, a bit in stocks if they want liquidity, and then some into alternative assets, of which, wine and whiskey is a great choice.
You mentioned the Wine Investors Playbook. I love that name. Very, very similar to the Passive Investors Playbook. Nice. So thanks for plugging that there. But
nice. Yeah.
and then that's going to go live probably maybe by the time this airs, a month or 2, you think, or when?
Yeah. So definitely by about Q3 this year.
Okay, perfect. And is that going to be on the website, on your website?
Yeah. So how to reach me? I'll drop the website for the fund and everything here. Like all my details are on there, and
sure,
submit your details. I'll be able to contact you. But otherwise, LinkedIn, Maxwell Nee. You can search me up. I'm the only one on LinkedIn. MAXWELLNEE, which is November Echo. I'm addicted to LinkedIn. So if you add me there, send me a message, you'll get a reply, within 20 hours or less. So, and most people reach out to me from podcasts on there as well. And my email's on there as well.
Okay. Very cool. All right. And then I know we've spoken about your fund a little bit, but if someone wanted to reach out to you, I know you mentioned you're on LinkedIn. We'll put the website in the show notes as well. Is there information on the website about the fund?
Yeah, as much as we can, like obviously with a fund, there's rules about what you can and can't sort of solicit to people. But as much as we can, it's absolutely on the fund. And, if you send me an email, we could, we fill in your details. I can get like the 1-pager to you, or like a deck to you, or whatever else. Yeah.
Yeah. Okay. Awesome. That's great. I want to ask, we have a few minutes left. I want to ask about maybe a book that stands out to you that you've recently read. Typically, I say real estate, business, or self-help. In this case, we can add wine and whiskey in there too.
Yeah. So this is a really good question. If I was to answer this question purely as someone who wants to learn and not be a business owner, I would probably say the book I'm listening to right now is called Range, which is a book about, that if you specialize too much in something, it kills your creativity and it makes you actually less effective compared to if you, specialize in a few different things, but then have one as your main focus, like swapping your skill sets, having range across your skill sets makes you better at all skill sets. I'd say that book. But if you're like a business owner and you want to build wealth and you got to hustle and that sort of thing, definitely the book that you write, because writing forces you to synthesize and distill your best thinking, your thoughts, which helps you to understand it even better, so that it's even better. You know what I mean? So like if you force yourself to just go through that painful process of putting your thoughts down on paper and that sort of thing, like your best business ideas, and sharing that, whether you share it with someone doesn't matter, but if you just went through that exercise, you would definitely grow and those ideas would get better in that process.
I love that. I'm a big proponent of, if you're training a new person, have them do some of the training modules, teach them how to do it. And then after, a week or a few days, whatever it is, have them teach you how to do it, because they learn so much better. And so that kind of
the same thing.
Yeah, exactly. Love that. And Range, that sounds extremely fascinating. And when, we earlier talked about Rich Dad, Poor Dad. That's kind of the same as the Poor Dad, I think, where he got all those certifications and degrees and became this top teacher in Hawaii. But then after that, there's really no place to go but stay there, right? Or he'd have to completely leave because he was at kind of the top of his career field. So
so it's a really interesting book. Like really quickly, this range book, it talks about like professional athletes, right? And it said that, so they broke down the signs of how someone becomes a professional high-end athlete. And usually athletes, when they are young, they go through a sampling phase. And what they found was that more or less athletes that go through a high level of sampling of like 20 different sports ended up mastering that one sport better compared to the one that just focused on the one sport right from the beginning and didn't change.
Wow.
They performed better. So the example they use is actually Roger Federer. So Roger Federer went to sports school playing soccer, football first. And he played a whole bunch of other sports, and then he found that he enjoyed tennis, and then he became obviously really good at tennis. And they compared another person who was this boxer. So there was the guy that trained for boxing, and when he was young, he did gymnastics, dancing, ballet, like he did all this random stuff. And then so he had an edge in how he boxed, as an example. So it's about that sort of stuff.
Very cool. And thank you. I'm sure the American audience said thank you for saying soccer instead of football. I know you also said football, but okay. What can people expect to see from you and your business over the next few years?
Oh, wow. Good question. Yeah. So, I'll be speaking as much as possible, about, wine and whiskey investment. I'll be getting the book out, in the next few years, the whiskey investment book will be out. And then, I'm often working on a few different projects. Obviously, got this real estate deal that we're closing. So I don't know, to be honest. I don't know towards the end of that period of time.
Man, yeah, you got a lot going on. I know you mentioned you're speaking in Vegas coming up and writing a book. You're doing some development. So hopefully you get some time to sleep in there. But
yeah,
very, very cool. And Maxwell, I know you already mentioned this, but people can reach you on the website. We'll put that in the show notes. LinkedIn is probably the best option. I'll put your link in the show notes as well. Any other ways that people can contact you, or are those the best?
Yeah, if you Google me, you'll see a whole bunch of pages. I think I've got one personal website up there. So I got the personal website. I got some, obviously my email, my LinkedIn, and you can contact me through Instagram. Like I'm pretty public and transparent. Very cool.
Okay. Maxwell, thank you so much for being here. This was extremely fascinating. I learned a lot, and probably use some of this in my business as well. So thank you so much for being a guest. Really appreciate it.
Oh, nice. My pleasure. Thanks, Charlie.
Thank you. Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing. Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.